All right, today we're breaking down a deep dive investment report on KFINTECH. Now, if you haven't heard of them, think of them as the company building the digital plumbing for India's entire financial industry. It's a fascinating story, so let's get right into it.
First up, a number that really jumps off the page, 24.8%. So what is that? That's KFINTECH's return on equity. In simple terms, for every single rupee that shareholders have invested in this business, the company is generating almost 25 paisa in profit. That is an incredibly efficient machine. And this kind of performance, it's not a fluke. This next number, 22.5%, is their average revenue growth, not for 1 year, but year over year for the last 5 years. That's the kind of steady, powerful growth that serious investors are always looking for.
But here's where the story gets even better. Check this out. Their profit has been growing at 28.8% over that same 5-year period. Now, why is that so important? Because their profit growth is actually outpacing their revenue growth. That tells you that as this business gets bigger, it's also getting more efficient and more profitable. That's the magic formula. So, what's the big idea here? What's the main takeaway from the report we're analyzing? Well, it's right here on the screen. The core argument is that KFINTECH is in the perfect spot to ride some of the biggest waves in India today. More and more people are investing their money, everything is shifting online, and the rules are getting stricter, which requires exactly the kind of tech they provide.
Okay, so that's a pretty bold claim. Why is the report so confident? Well, to understand that, we have to zoom out and look at the massive digital transformation happening all around KFINTECH.
You see, KFINTECH isn't just a good company operating in a vacuum. It's a great company in the right place at the exact right time. You've got the government's huge Digital India initiative. You've got regulators like SEBI, that's India's market watchdog, basically forcing the industry to go digital. Then there's the Jam Trinity, which has brought hundreds of millions of people into the formal financial system. And on top of all that, you have a boom in everyday people investing through things like SIPs. It's like having a hurricane-force tailwind at your back.
So the environment is perfect. But what about the company itself? What makes KFINTECH so defensible? Well, the report argues that it has a very, very strong competitive moat.
Now, if you're not familiar with that term, don't worry. A competitive moat is just a cool way of describing the special advantages a business has that protect it from competitors. Think of it like an actual moat around a castle, making it really hard for anyone to attack.
And this slide really lays out how KFINTECH built its fortress. First, the regulations in this industry are so complex that they create a huge barrier to entry. Second, once a big client like a mutual fund starts using KFINTECH's platform, it's a massive headache and super expensive for them to switch to someone else. That creates what we call sticky revenue. And finally, this isn't a business you can just create with code. It requires decades of specialized, deep knowledge.
But, it's never that simple, is it? The report also looks at what the market is saying, and there are really two sides to this story. The bulls, or the optimists, they love the company's dominant market share and its amazing financials. The bears, on the other hand, they point to a major concern, the stock's high price. They also worry that the company is too dependent on the mutual fund industry and that some new technology could come along and change the game.
All right, the story sounds compelling, but talk is cheap. Let's dig into the numbers and see if they actually back all this up. Does the financial picture look as good as the story?
So the analysts behind this report went deep. They looked at 44 different financial ratios. And the summary, well, you can see it for yourself. It is a clean sweep. Excellent across the board, from cash on hand to debt levels to profitability. This is what a financially rock-solid company looks like on paper.
And here's that growth story we talked about at the beginning, but now you can actually see it. You can see that revenue bar growing at a really fast pace, but look at the profit bar, it's even taller. That's the key takeaway right there. As the company gets bigger, it's getting even better at turning that revenue into cold, hard profit. That is the definition of a scalable business.
So you might be wondering, how did the report weigh all these different factors to come to its conclusion? This gives us a little peek under the hood. You can see that financial health, growth, and that competitive moat we talked about make up a massive 70% of the total score. Valuation is in there, for sure, but the analysis clearly cares more about the fundamental quality of the business itself. All right, we've looked at the big picture, the moat, the financials. So where does this all land? What's the final verdict from the report? And maybe more importantly, what are the risks we absolutely have to keep an eye on?
To figure out a fair price, the report uses a discounted cash flow analysis, which basically projects future earnings. And you can see it gives a range of outcomes.
What's interesting is that even in the pessimistic bear case, the valuation doesn't completely fall apart. And in the optimistic bull case, there's a lot of potential upside. But the number that the report really hangs its hat on, its most probable or base case scenario, is a target price of 575 rupees. This is what the analysts believe is the most realistic fair value based on their assumptions.
So what did that mean in terms of potential return? Well, based on the stock price when this analysis was done, that target of 575 rupees suggested a potential upside of just over 10%. So a solid potential return, if not a home run.
And of course, and this is a really important but, no investment is a sure thing. No analysis is complete without taking a hard, clear-eyed look at what could go wrong. Understanding the potential downsides is absolutely critical. The report flags 5 big ones to watch. The first is valuation. When you pay a high price for a stock, it's vulnerable if growth slows down. Then there's the risk of new competition, maybe from a global giant. The risk that regulations could change, the risk that the company relies too heavily on just the mutual fund industry, and of course, the ever-present threat of some new technology coming along and making their platform obsolete.
And that brings us to the final central question that this whole analysis really leaves us with. You have a fantastic company, financially strong, with a great competitive moat, and it's riding these huge industry tailwinds. The report sees a clear road ahead, but it all comes with a premium price tag. So is the biggest risk here not the business itself, but simply the price you have to pay to own a piece of it? That's the critical question to ponder.